Morning, everyone. Welcome to our Lessor's Risk product webinar. That's a mouthful to say, but this is a great webinar on finding out more about Lessor's Risk, which is always sort of a moving target and a mystery to insurance brokers. My name is Anae Agostini. I'm CEO of CID Insurance Programs. I also want to introduce Michelle Belden, who's our commercial underwriter and specialist in Lessor's risk coverage. And Jacob Cole is our marketing specialist, and he is running things around in the back area, make sure that we get all your questions when they come in. And so welcome to the webinar. Let's get started. So, got a few logistics to get out of the way. Each of the participants, you'll be muted. You'll be able to hear, but there's so many of you that we can't all talk at once, so that's why we're on mute. However, we really want to hear from you, and so we want you to pose questions at any time throughout the webinar, and we will answer them in the moment as they come in. So please feel free. We encourage you to do that. Everyone will be able to see the questions being posed so that, it may prompt some questions of other people. And again, we welcome that. At the end, we'll do a short survey, and we'd really appreciate your feedback. We rely on that to find out how well we're doing. If you have any suggestions for other courses, feedback you want to give, we would love to hear from you. So let's talk about our objectives. What do we really want to learn? I'll tell you, I'm going back many, many years because I've been in this industry, 30 years. So I can remember when I was doing exactly what you guys are doing now, a retail and commercial business. And you have a lot of different classes of business that are coming at you, and you're trying to figure out how to, what coverages each one needs. Lessor's Risk is one of those that is sort of like a mystery. But the one thing I want to say is that it really, I discovered that it was a fast way to build premium for building my commercial book of business back then. So there is some premium in because you're going to be insuring buildings, and there's property insurance, and that's what drives your premium. So pay attention. That's because the small policies are not going to make you successful, but they're still an important part of building your book. You must have larger premium size policies that you're writing on an ongoing basis, and then getting those to renew each year. So let's start with the objectives. We want to recognize and understand the different types of commercial buildings. So that some of that is where it gets confusing. So we'll go over a little bit of that. And then let's talk about the underwriting guidelines that you need to be considering because there's some different types of risk involved in Lessor's Risk, and you will need to know the underwriting guidelines. And then it's important to know about the property components and how to insure them. So knowing what to insure is one of the biggest questions. So last is Michelle's going to talk about a lot of this, but she's also going to cover the secrets to fast quotable submissions. And that's, that again is one of our biggest goals, is to make it easy for you to be able to write business with us. So let's get started. And no better place to start is where we talk about, let's just do a definition. And this is where it does get confusing. The Lessor's Risk is really where you're providing a liability and property coverage for a building owner who leases out their entire building or occupies less than 75% of the building. So you want to think of it, so it's really where you think of it as a landlord insurance policy, because the landlord is renting out to commercial tenants in one way or the other. So the building coverage is required because you're insuring the building, right? But business personal property is optional. So this should make sense. As we go along, if you have questions, please type it in. But again, think of this as landlord insurance. Okay? So let's talk a little bit about the different types of lessor's risk buildings. So one of the easiest to spot, and I'm going to show you some examples in a minute, would be a professional office building. And you see a lot of those. They could be, ideally, I wouldn't venture towards the high-rise buildings, but I would venture towards the 1 to 4 story professional office buildings that you see out there. You're going to have that's going to be in a range where you're going to have by far more carriers interested in writing that. Commercial buildings. What are we talking about? What do I mean by that? Typically, that it's some kind of commercial business exposure, more related to industrial or light manufacturing, where it's not just professionals in an office building inside offices. You'll have more of a light manufacturing, industrial type mixture of classes, tenants in the building. So mixed use buildings. What are we talking about? You definitely are going to see a combination of it could be professional and retail. It could be a combination of professional and commercial. Your industrial or light manufacturing. Typically, these complexes will draw either all professionals or all the commercial exposure. However, they all vary slightly. That's why Michelle's going to talk about getting a rent roll and a list of the tenants and a description of the type of business that they're running. Next is retail strip malls. We drive by them every day on the street, right? But you can have a wide variety of tenants in the strip malls as well. So last, which technically is not a lessor's risk, but I like to throw this in because it's important to understand that they're building, especially in California and building outside of California now, business park associations, and they're like condominium associations, but they're for businesses. And you need to know whether you've got a nonprofit, building that needs to be addressed in a different way and is not a landlord exposure. That's where you can get confused. And a lot of times, they'll fall into the professional or the commercial building arena, and that's what you'll have inside. And it will typically look like those types of complexes, but you need to ask that question. So let's look at some of these buildings. We've, example left, professional building, and again, remember I mentioned a business park association could look like that as well. So you have to ask the question, what am I dealing with? Is it a lessor's risk, or could it be a business park association, which is a nonprofit entity, and the membership, it's the unit owners are members of the association. So important to distinguish the difference. And then on your right is a retail strip mall. Again, this is just one example, and you can see there's a lot of tenants, small unit tenants in there. Other strip malls will have large, tenants in there, maybe a series of small ones and then a big, large one. But you're going to have a wide variety of different types of exposures, from restaurants to retail to gyms, so all of those could, you have to pay attention to who the tenants are. Okay. And then here's another couple of them. So here's an example of a commercial building. You can see that you're going to see roll up doors where you might, where they're storing inventory or things like that. They may be working in a warehouse kind of situation, and But sometimes it's hard to tell because on first glance, this looks like it could be a professional office building, right? But typically, this is what your commercial, light manufacturing, industrial type complex is going to look like. But if you go around the corner, you're going to see that the backside is where all the action is taking place. Mixed-use buildings is on the right is an example. This one looks more like it could be it could be an office building above, but you've got a sports bar below, so you've got some retail exposure there, and you have to know how to ensure that and how to communicate it to get the proper quote. Michelle will talk more about that in just a moment, and I'm going to turn it over to Michelle now.
Hi, everyone. So I want to go over some underwriting guidelines to consider. And I just went over a lot of the types of occupancies that we can you see, and I just wanted to add a couple things there as well. For mixed use, also I can consider what I also consider mixed use are anything that has retail or a restaurant on the bottom, and then maybe a couple apartment units above. That's also another version of a mixed use building. It doesn't have to be strictly a commercial with a professional office. It could actually have some residential units in there as well. So that's another thing that we can consider. And then Anae was also talking about knowing the difference if it's a business park association or if it is truly where the building owner is the one that owns all of the units and is renting them out to everybody. But if it is a business park association and the unit owner does own their unit, they can still rent out that unit to somebody else. So they themselves, as the unit owner, would still need coverage for the interior of the unit, and we could just consider that a commercial condo, and that's something that we can write coverage for as well. We can provide the interior building coverage that they would need. Generally speaking, it's considered tenants and improvements and betterments. So that's just another one. So I know there's lots of different areas where LROs can fall in, what classification they can be, and there's pretty much something we can find a box to put it in. So as Anae was saying, professional offices are generally going to be, I'm going to have the most amount of markets for them. They are the most preferred class. They're the easiest to write. They don't have the greatest foot traffic. So, there's less concern for there being a possible liability claim. And then your commercial buildings, as Anae was saying, your retail stores, your light manufacturing, warehouses, those are going to probably be your next easiest to write. And then your hard-to-place type risks generally have garage-related tenants, whether that's an auto repair store, auto dealer, and then restaurants. Those can get tricky, just depending on the type of restaurant. Is it a fast food restaurant? Is it a sit-down restaurant? Do they do any sort of like open flame cooking inside the restaurant? So there are different factors that play in that make restaurants a little bit harder tenants to write. Generally speaking, anything that's furniture related or wood related tenants, those are generally pretty hard to place because they are, they can cause a fire quite easily, things like that. So generally speaking, are hard to place. We're looking at E&S type markets to place those businesses in. And then a rent roll. Anae was talking about a rent roll. So a rent roll provides us with a list of the tenants in the building, gives us the name and description of their operations, the square footage. So it helps me, figure out if it's occupied by multiple tenants. Where can I place this business? And it helps me break down the square footage because then, maybe you have a vacant unit. And so it helps me break down the percentages. Because we can consider LROs with vacant units in them. I can actually go anywhere from 30 to 70% vacant. Just depends on what the other tenants are and the type of building and what markets I have available. And if I'm not able to help you on that, on our vacant side, Teresa in my office, she handles vacant, so we can flip it over to her if it would fall more in her arena than it would mine.
That's great. We have a question, Michelle. Is there a market for historical buildings that are mixed-use, retail, and residential?
I do have some markets more through E&S related carriers, so like your Scottsdales and your Mesa Underwriters, I can consider historical buildings through them. They don't have a problem. And then I do have a couple other markets that will consider historical buildings. I just kind of have to know a little bit more about the building, especially when it's on a historical registry. Not all markets are taking those type of ones.
Okay. And there's one more comment on there. I'll let you take it into consideration.
Mm-hmm. Okay. All right. So the condition of the building, that is the main thing that I'm after. We will consider the older buildings. I've written things as early as the late 1800s, like 1890s, all the way to present day. So as long as we're looking for a pride and ownership in the building, I'm not looking at a building that's falling apart or anything like that. So, but with the older buildings, we're looking for updates within full updates. So that's to the heating, wiring, plumbing, and roof. Within the last 25 to 35 years, that number varies by my markets that I have available, but that's generally the benchmark that I let my retailers know. That's what I'm after. So like I said, we're looking for well-maintained buildings with pride and ownership. They are responsive to loss control, wanting to, try and keep their loss ratio down, and same thing. So we're just, looking for clean buildings. They can be older. Believe me, I've seen older buildings that look nicer than newer buildings. So it really comes down to the owner and how well they maintain the building. Next slide, Renee. All right. So some other things to consider. The number of stories, again, and I know Nate had mentioned earlier, we're not necessarily after the high-rise type buildings, that those are generally harder to place. My markets get really limited once we get over about 5 stories. And generally speaking, the most stories that I generally get generally caps out about 3, but like I said, I can consider them if they're higher than that. It just my markets become limited. And then, I have markets that will consider non-sprinklered buildings, which I know here, especially in California, on our older buildings, most of those buildings aren't sprinklered, or, because it costs a lot of money to go ahead and update your building to add that in there. So I do have markets that will consider non-sprinklered buildings that are over 3 stories. And I also have, preferred markets that are that offer a sprinkler credit because your building is sprinklered. So again, that's just going to vary. And then other things to be looking at, the walkways and the parking lots. Are there potholes? Are there cracks in the sidewalk? Is the sidewalk lifting up? Is there something that could cause a potential slip and fall claim? Those are kind of things that we're looking at when it's talking about uneven concrete walkways and parking lots. And then stairways and railings, that is becoming a big thing. Right now, we've got railings where, the spacing is too wide. So we're looking for spacing to be at 4 to 6 inches, no more than that. Anything over that for your railing spacing is going to cause a problem on a loss control inspection and something that would need to be fixed. A simple fix that I, always recommend to people who don't want to spend a lot of money is if you just put some mesh up in between, you down, even if you don't shrink the spacing, you have, because you put the meshing up and you can't get through it. So, a small child couldn't crawl through it. Also, what I'm currently seeing is horizontal railings. That's becoming the new thing for contractors. They think they look nice, which they do. However, they act as a step ladder, so to speak. So a small kid or, anybody could decide to climb up it, get to the top, and then fall over. So no horizontal railings. I don't know really of any markets that are considering those. I've been seeing it more and more on quotes from my various markets saying, hey, no horizontal railings at all. And then we do require for all of our markets that we have that write lessor's risk that the tenant provides the landlord, the building owner, with a proof of insurance, or certificate of insurance, and they also need to name them as additional insured on their policy. And that's very important. Most of our markets, when they do an inspection, they are confirming that information, or they require a copy of the certificate in order to bind the coverage. So you want to make sure that your tenants have coverage and are providing the building owner with that certificate and showing that they're named as AI on their policy. And I've already mentioned, I'm sorry, go ahead, Renee.
I was just going to say that's a really good risk management tool to teach your client, the landlord, that you would be providing the insurance for. And the other area is with the stairways and uneven concrete walkways. We're trying to give you a heads up relative to the fact that everybody knows that there's going to be an inspection done on the property, and that's where you end up getting caught. And so Michelle's giving you some really good information to inspect in advance in order to avoid or prepare your client for changes that need to be made to get competitive quotes.
Correct, yes. And so, as Renee saying, so all of our carriers, especially on our lessor's risk, they are going to perform an inspection because, that they're insuring the building. So they want to ensure that, we're limiting the possibility of the potential of a claim, which is what the loss control, is a result of. So, it's looking for, to confirm that we have the correct square footage on it, because that's what it's going to be rated on. The types of tenants that are there, confirming that they have and provide the COIs, and then any other things that they may notice that they want to make a recommendation for in order to keep your risk for your insured lower, so that they don't have that potential for a claim. All right, so we're going to talk about how a statement of values. So I really like a statement of values because it breaks everything down for me. Some people might complain because they think that they're labor intrusive. I don't think so at all. They are a way for us to see, if there's multiple buildings in a complex that need to be insured. So it breaks it down for me by the building. So it gives me a way to see what the square footage is for the building, what the limit is that you're looking for that building, because I'm not able to offer, with most of my markets, blanket property limits. So if there are multiple buildings that the insured owns and is looking for coverage for at one location, I would definitely need a statement of values because I can't blanket the limits. And then if I am able to blanket the limits, I still need this statement of values in order to provide the carrier with a breakdown and backup for them to see what building is covered at what amount. So like I said, it establishes a square footage per structure, and then it allows you to know what the square footage is at one building and then the next building and things like that. So it's really helpful for me on any location that has multiple buildings. If there's two buildings, then I'm fine with you completing an Accord 140 and then just putting in the information for building one and then building two. But generally speaking, when you're at 3 or more buildings, a statement of values is really helpful for me. And then it also allows you to, break down any other additional property components that may be at the property. So, if they have a detached sign, that's something that you would want to list out if you're looking to have coverage for. If there is a dumpster enclosure, that's another structure separate from the building. If it's not connected to the building, then it's separate from the building. Say there's a fence. They could just have a fence in the front, to block their parking lot or something, and if it's not attached to the building, then it wouldn't be a part of the building limit. So that would be, again, something else to break down, which, again, is why a statement of values is helpful, because it can break down the buildings itself, but it can also break down the detached property that you're looking for coverage for as well. And this is just a simple example of a statement of values that you can use. Like I said, it breaks it down pretty easily. You got your buildings, and you can break it down even, maybe the insured owns multiple locations as well. So you could do that any way to break down that information. And then you've got your other property detached structures that these are just some examples of things that you can put on there, and then it will total up our values for us. All right, so how to determine the values? How do you get your building value? So factors to consider or in determining your cost per square foot is, your state location and your construction type, the height of the building, and the quality of the building. Also, what makes up the building? You know, is it a 4-story building with an elevator? Um, Things like that. So what can you, how to determine how to do that? Also, you know, running a Marshall and Swift report or a building valuation report of some sort. I know there's many people out there that offer a service for that. Is a good way to determine your building limit. And also, you know, if these people are, it's a new purchase or a refinance, generally speaking, the bank is going to have run their own report of some sort and determine a value. And a lot of times, that's the limit that is required for them. So that's another way to determine the limit. I myself, when I get in a submission, I generally check the cost per square footage to see where it comes in at. So all I'm doing is taking the building limit provided and dividing it by the total square footage of the building and coming up with a number. And generally, I'm seeing anywhere between $115 a square foot to $240 a square foot. But again, like I said, it's going to vary by your state, the construction type, and things like that. So, you know, sometimes I get things that come in at $400 a square foot, and that raises a red flag to me. Why are you looking for such a high building limit? So at that point, I would generally probably be coming back to you and maybe having a little bit further discussion as why is the cost per square footage so up there? You know, was a number accidentally inverted, too many zeros added on, that type of thing. So when it gets into those higher values, that's kind of when I would question it, because it just doesn't seem right. But you know, everyone, it varies by thing, by every little thing can cause it to go up or down. All right, so coverages. You know, lesser's risk. A lot of people think that they just need property coverage, which that's fine. You can get just a monoline property quote, but we do recommend that the building owner get property coverage and liability coverage, because the building owner does have a liability exposure. You know, I mean, they obviously, like we've requested that the tenant provides them with their own insurance and things like that, but the insured, the building owner, is the one who, you know, is responsible for the parking lot. So there is that possibility for a liability claim to occur, and then the building owner could be drug into a lawsuit or something like that. So we do recommend that they have both property and GL. But again, we can write either one of those as a monoline or as a package. But within the property coverages, you know, a lot of people just think, oh, they just need building coverage. That's not the case. Loss of rents, business income, that's a really important coverage for them to have. With business income, I'm not able to offer ALS, actual loss sustained, so I would need a limit of insurance for that. So again, whatever they're collecting in their annual for their rents, that would be your limit. If you're not sure or your insured hasn't provided you with a limit, I generally say doing 7 to 10% of the building limit is a good place to start, just so you can kind of get an idea of where the pricing would come in at. Building ordinance, that is another coverage to have. That you can add. So there's building coverage, building ordinance coverage A, B, and C. So coverage A is loss of undamaged portion, and that will always be equal to your building limit. And then coverage B is demolition, and then coverage C is increased cost of construction. And with coverages B and C, you can either write those as individual limits, where B has one limit, C has another, or you can do it as a combined limit. And generally speaking, I see most people write it as a combined limit. And if you were going to write it as a combined limit, you're generally looking at 10% of the building limit. Sometimes I see up to 15% of the building limit. So again, it's, you know, it's based on preference of the insured and what you're looking for. And then another property coverage to consider is equipment breakdown. You know, if they have a boiler and machinery, or maybe there's a pond or a lake, or there's some type of machinery on there, that's a good coverage to add on there. I see we have a question. Is loss of rents always 12 months or is more available? I do have the option with some of my markets to do 18 months and 24 months for the business income. And then another coverage to consider under the liability would be hired and non-owned auto. And can you go to the next slide, please? Yes. All right. So I was just talking about liability. So most of my carriers do not have a deductible when it comes to the general liability. I do have a couple that have a minimum of a $250 deductible, but other than that, generally speaking, you're looking at a $0 deductible on the general liability. And then for coverage form, we can offer special form replacement costs as long as the building, as I mentioned earlier, is either newer, has been built within the last 25 to 35 years, or maybe an older building that hasn't updated within the last 25 to 35 years. Then we can offer special form replacement costs. Otherwise, basic ACV is definitely available. I have some people who, even if their building qualifies for special form, they're just after covering the actual cash value of the building, so they'll take that option. But we have both options available. Generally, our liability is 1-2 limits, standard with most of my markets. I don't have too many markets that will do 2-4, but that's not a problem because I can write an excess liability policy with limits up to $10 million. I do have some markets that might go a little bit higher. It just depends on the risk and the carrier's appetite and things like that for us to be able to see if we can go higher than that. But even also another thing with excess liability, if the insured owns multiple properties, having an excess liability is a good thing to have, especially if you're scheduling all of the locations that they own on one policy, because then if you're only giving them 1-2 limits and say they own 5 locations, they're having a combined, all 5 of those locations are sharing that $1 million, $2 million limit. So having an excess for them provides, instead of writing them all on their individual policies where they each have their own $1 million, $2 million limit, an excess liability policy is a good thing to have for them. And then property limits, like it says on there, we can go up to $50 million. I have some markets that will go up a little bit higher than that. Again, it's just going to depend on your occupancies, where the risk is located, so things like that. But generally speaking, I don't get too many that go over $50 million. Now, if they own multiple locations and it equals $50 million, that's different. We're talking about $50 million at one location. And then just a couple other things I want to mention are we have both preferred standard and E&S markets available. So generally speaking, we can find a home for your insureds with the type of tenants that they have. They may not all, obviously, like I had mentioned earlier, garage risks and restaurant type risks. Those are generally harder to place, but we can generally find a home for them. All right. So this little risk profile here is a little cheat sheet that we like to give to our tenants, or I'm sorry, to our retailers in order for them to gather information. So, if you are speaking with somebody on the phone or somebody walks into your office, or you get a warm lead from somebody, this is a good way just to collect the basic information in order to transfer it on to Accords. So this itself is not an application. It's just a good tool to use to collect the information. Just so you're not just scribbling down on a little piece of paper and going, oh, what did I do with that piece of paper? This is a good way to get all the information that you need in order to transfer it over to the Accord applications. It also is a good tool to use for new purchases. Those are definitely something that we can write. I get a lot of those requests all the time. Escrow's getting ready to close, so they need to get insurance in place. So this is a good tool to use for that. And before we move on, I see we have another question. Yes, I can consider cannabis-related tenants, whether they are a grower, retailer. I do have markets available for that. So generally, if they are a growing operation, that will fall in my E&S related markets. But if they are just like a retail storefront, I can consider that with some of our standard markets. Okay. All right. So I've gone over all the things that go into what I'm looking at when I'm underwriting the risk. Now, what you guys need to send me in order to get a submission and get a quote from me. So I will need an accord, 125, 126, and 140 if they're looking for both the general liability and the property. If they're looking for one or the other, then just send in the appropriate accords that I'll need. And I do need a list of tenants, so whether that's you listing them on the accords yourself or providing a rent roll. Generally, if it's, there's like 10, 15 tenants at one location, a rent roll is better than you having to write out all of that on the accords. So that's an easier thing to do. I do need some sort of a lessor's risk supplemental. If you already have one completed, I can generally work off of that. We're really good at being able to work off of other carriers and other people's supplementals, as long as it provides us with enough information in order for us to quote. Otherwise, we have a supplemental, which we'll be sending out to everybody after the webinar. So you guys can have a copy of that, and you can just save it on your desktop, and you'll have it ready to go. If they've had prior coverage, loss history is always a good thing to provide for me. Varies by carrier. 3 to 5 years loss history is generally what I'm looking for. If they have had losses, we can still consider. I just need to know a little bit more about like what happened, what caused the loss, if there was any sort of property damage, confirming that all the damage has been repaired, and if there was something that could be done to try and prevent another loss in the future of a similar instance from occurring again. Those are the kinds of questions that I'd be asking about any losses. Open losses, we can consider. It does become tougher. And again, generally speaking, my E&S type markets would be the ones that would be considering that. So it's just going to depend on the loss, what happened, and further into that. If you have a target premium, that's always helpful for me. So I kind of know, like, am I in the ballpark on this one? Am I even going to be competitive? It gives me an idea and, lets me know where when I'm looking at my markets, are we competitive? Why aren't we being competitive on this one? What is causing that? So that's always helpful. And then, like I mentioned, our supplemental application, which you can find on our website, but we'll also send you guys out a copy of that as well. So you can find all of that on our website. And then also, I know we're getting to the point where everything's digital, so you can go in and type in the applications. They're all fillable. You don't want to print them out to sign it. That's not a problem if, the insured or you use a service like DocuSign or DigiSign. That's totally acceptable, and we can accept electronic signatures like that.
Wonderful, Michelle. That was great information. That concludes our webinar. I want to thank you all for joining us. If you have any questions still, go ahead and type them in while I'm finishing up, and then we'll make sure that Michelle gets a chance to answer those for you. Don't forget our website. It's full of all kinds of tools. We've got marketing tools that are fillable to put your information on that you can use with your potential clients or even with renewals, which is helpful. Our webinars are this particular webinar will and all of our webinars are the recorded versions are published on our website, and then you can see our upcoming webinars that you can register for there as well. Contact Michelle. You've got her information here. But that's, what's most important to us is that we respond to you in a very efficient manner with knowledgeable information that can help you get the job done for your clients. And then again, you can always copy your underwriter if you want, but make sure you send it to submissions at CID so we log you in. And let me just see, I think that was our last question. So we look forward to doing some business with you. For those that are already doing business with us, we thank you for your business, and we look forward to doing more with you. If there are no other questions, then I will let you guys go get to work. Have a great day.
Thank you.